Welcome back to Yahoo Finance Live, everyone. Major averages are in the red. They are dragging during today's session. As we close out the first quarter in 2022, let's bring in Brent Schutte, who is the Northwestern Mutual Wealth Management Chief Investment Strategist. Great to have you here with us. First and foremost, I want to talk about what this sets up for the rest of the year, especially as investors are looking at a more hawkish and aggressive Fed that is trying to counter inflation. You've also still got international conflict that clearly still unresolved, but more importantly, it perhaps paints a picture of what globalization may look like in the future, or some pullback of that to some extent, at least.
Yeah, I mean, I think you see continued economic growth throughout the year. The question is, to me, is can the U.S. economy withstand the recent commodity price shock? And I think the answer is yes. If you look at the consumer debt to net worth is 12% versus 24% when we last had a big oil shock back in 2008. So it has a much bigger room to absorb any price increase on the commodity front. And commodity costs are certainly a smaller part of the consumer's budgets today. So if you think about that consumer, I think they have the ability to withstand it. Corporations are still in great shape. Banks are still lending. And all in all, we do expect the economy to push forward, which I think will eventually bring the market with it. Now, on the inflation side, it's certainly a bit muddier, but I think you're starting to see signs that COVID inflation, which was all about goods buying. So if you think about goods, they are shipped around the country. They actually arrive in crates and boxes and things of that nature. That was really pulled forward by COVID. People stayed in their houses and they bought home furnishings. And that's really been the driver of inflation. If you believe that COVID continues to ebb, hopefully, and people go back to being in offices like I am today and being out and spending money on services, we do think you will actually see inflation pull back and roll over, certainly not back to 2%, but enough to give the Fed leeway to go a bit less aggressive than what people are currently pricing in. And that's the impetus for a higher market moving forward.
I'm sure you heard our previous conversation before the break, but it seems that consumers are still having to spend more right now on gas, on energy, rather than some of the products, the services that would lead to us having this kind of immediate term or continued economic reopening and bounce back. And so with that in mind, where does that kind of place us on some of the GDP growth goals that we have going on throughout the rest of this year? The Fed has put theirs out there. Yours, in the immediate term, you're still looking towards positive gains, it seems, right now.
Absolutely. I mean, I think GDP is undoubtedly going to pull back from last year's stimulus-fed GDP, where people came back out in public and spent. That's not a question, but I still think it's going to be positive. It's one thing if the consumer has to spend more money on gasoline when they're strapped. They are not right now. They actually have ample cushion to withstand this. Certainly, if it goes on for years and years, then there is more of an issue. But I think that's point number one. Point number two is we have to remember that the U.S. economy is different than it used to be. We produce around 11.6 million barrels of oil a day. If I take you back to 2008, because I brought it up before, we only produced around 5.6 million barrels. And so rising gas prices overall to the U.S. economy is not as outright negative as it used to be.
And so if we think about what the Fed has said recently as well, the probability of a recession within the next year is not particularly elevated. They also believe the economy is very strong and able to withstand tighter monetary policy. It seems that you also lean into that particular measurement that the Fed is looking at, and that ethos, that belief that the economy is strong enough to withstand some of their tightening monetary policy. And so going forward from here, where would you expect companies to forecast their relationships, their engagement with the consumer as of right now?
Well, I think corporate earnings are still rising, and it's still expected to be fairly strong this year. Certainly not as strong as last year, but rising nonetheless. And I think that will help, obviously, the stock market push higher. To me, I think you have all the backdrops of a Federal Reserve that certainly wants to keep inflation under control. But this is the important narrative, because I keep hearing this commentary about, can the Fed engineer a soft landing? My question is, my answer is, it's probably not going to be a soft landing, but rather a harder landing. But I think the important thing is, what side is the Fed going to err on? Are they going to err on the side of actually tightening too much and having the accident be a recession? Or are they going to err on the side of still tightening just a little bit less, letting inflation run, but err on the side of just allowing that too much inflation to kind of keep going and allow the economy to keep pushing forward? And I think that's where the accident's going to be. I think they're going to allow inflation to push a little bit, to roll over, but not come back to their 2% target. But certainly they don't want to cause a recession. They want to keep the cycle going. And I think they have the leeway to do so. And so they are not going to tighten the economy into submission, rather try to fine tune it to get a longer economic cycle.
All of these things considered, how are you positioning your portfolio?
So if you still think there's economic growth, as I mentioned before, I can give you with pretty high probability that stocks will be higher in that backdrop. I think the question that investors have is, where do you want to position? As you asked, we still think there's opportunities in value stocks and in small cap stocks. Those are things that are quite a bit cheaper. The argument against those is that the economic cycle is rolling over and therefore you want to be in higher quality and larger caps, but I can't ignore the valuation differences. These valuation differences between growth and value are still incredibly stretched in favor of value. These valuation differences between large and small are still incredibly stretched in favor of small cap. And so we're in the things that are cheaper right now, and we think that will continue to work. And by the way, it has worked in the first quarter. While the stock market overall is down, value stocks are actually up.